Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have an extra special guest. If you are at all interested in fixed income, how you assess bonds, how you evaluate the economy, the market, what the Fed's going to do, what clients want, how to assess risk in credit markets, well, then you're going to really enjoy this conversation. Matt Eagan has spent his entire career in fixed income, from credit analyst to portfolio manager. Now he's the head of the discretion team at Loomis Sayles, which manages well over $335 billion in client assets. He's really seen every aspect of the fixed income side, more than just a bond manager, but someone who has really covered it from credit analyst to research analyst to fixed income member to full unconstrained bond manager, and now running this discretionary team. His group has about $75 billion that they're responsible for. I don't know what else to say other than there are a few people in the world that understand running a fixed income portfolio on behalf of institutional or retail clients, as well as Matt Eagan does. I thought this conversation was fascinating, and I think you will also. With no further ado, Loomis Sayles, Matt Eagan.
Thanks for having me, Barry.
Well, thanks for coming. Let's talk a little bit about your background. You get a bachelor's from Northeastern and an MBA from Boston University. Was finance always the career plan?
It was not. I started Northeastern as an electrical engineering major. And the good thing about Northeastern University is they have a tremendously great cooperative education program that saved my life because it made me understand I did not want to be a double E or an engineering in my profession. And the key was I started after 1 year, I kind of gutted through 1 year of engineering classes. I wasn't really that interested, but I gutted through it. And I started interviewing for the first internships. And I started, I had a number of them. I realized I am not like these people, and this is not what I want to do. And so I transferred to the business school after that.
It's so funny you say that. I started out math and physics. And in high school, I was a rock star in math and physics. And you get to college, and suddenly it's like, oh, I'm okay at this, but those guys are great.
Right.
And you quickly realize, hey, this is way above my pay grade. I need to figure out what I need to do. So Northeastern and Boston, were you a Boston kid?
Boston kid. I grew up outside in a relatively small city and, of course, moved to the city to go to school and just fell in love with Boston. Have stayed ever since.
Right. Oh, that's interesting. And is that where you are today? You're not New York. You're Boston.
I'm in Boston, right.
Huh. And there's a giant set of finance firms in Boston. That must be fun.
There was a lot to choose from. As a newly minted finance major coming out of school, there were a lot of things to do. This profession wasn't necessarily my first choice coming out of undergrad, but there were plenty of other things to do in the field too. It's a broad field,
to say the least. So you start out credit analyst at Century Bank and Trust. Prior to getting an MBA, what was it like being a credit analyst in the 1980s?
Yeah, I gravitated to, I had envisioned myself as a commercial banker. Back when I graduated, and I had done an internship at BancBoston. One of the first things I did was spread financial statements. This in the old days before really there were spreadsheets there. And we would take Fortune 500 annual reports or 10Qs and put them into a spreadsheet, give them to the commercial loan officers. That was when I first started getting involved with looking at companies. So when I fancied myself as a loan officer, there were great programs in that field. There was a super regional banking industry in Boston. However, when I graduated, there was a really kind of a nasty correction in the market.
What year?
1989. And you remember there was a pretty nasty recession in 1990. Believe it or not, Massachusetts unemployment was over 10% back then.
Wow.
Which is hard to believe because Mass always has relatively low. But there was a real estate crisis back then.
We were just talking about this over the weekend. The problem with the financial crisis models were supposedly many failed to contemplate real estate prices going down. But I remember coming out of grad school in the late 80s and friends who had purchased co-ops in New York City in like 87, 88, 89, you didn't get back to break even until like the late 90s. There was a major dip. It might have been worse in some areas than others, but nationally, real estate foundered in the 90s.
Right. New England was crushed.
Yeah.
There was a big glut of condos. You'd ride by certain, you'd be on the highway, you'd go by, say, 100-unit condo building, and there was one light on.
Right.
It also hit hard in Texas too, which was, after the oil bust.
The see-through buildings.
Yep.
Right.
So that was the origination of see-through buildings.
Right.
And it was a great learning experience to me. But first of all, when I was in the, looking for jobs, you had to go to the placement office back then. And as I was looking at jobs, I remember looking at a GE finance job, and as I was looking at it, somebody pulled it down in front of me and said, it's not available anymore. That's where the economy was at that point.
Right.
And so, but I knew a fella, this guy, George Duncan, who was a friend of my dad's. He was a president of a small bank, Enterprise Bank up in Lowell. He didn't have a job for me, but he got me in touch with Century Bank and Trust. I had an interview there, became credit analyst. I was thankful I had an opportunity at that point. So I did that first. And that was a good learning experience. Again, what I witnessed then as, that real estate bubble kind of burst is those same loan officers with their underwriting loans that I was helping them do, they became landlords.
Oh, really?
That was the thing. Because they were, they were taking on some losses, and they would have to go in and show the buildings,
in other words, they would take over the buildings.
They were taking them over, yeah.
So,
that bank did fine. We were fine, but, it was an experience.
So essentially they go from underwriters to default managers to suddenly we're a real estate portfolio.
Right. It's like working with the borrower, right? That concept. But I didn't stay there that long. I learned how commercial banking worked, but I had an opportunity after that to move over back to Bank of Boston, which is where I was interested in at the time.
So how did you end up as a senior fixed income analyst at Liberty Mutual Insurance?
It was funny, that same fellow, George Duncan, when I talked to him, he said, go check out this bank. He said, whatever you do, you're going to need to go back for a graduate degree. Go get your MBA and make sure your company pays for it. And the guy who ran Century Bank and Trust was an older fella, guy Sloan. It was a family-owned bank. And I asked him, Mr. Sloan, will you pay for my MBA? He said, absolutely not. He said, you're going to get it and you're going to move on.
Fair
Said,
assessment.
all right, and actually, so that's why I went to Bank of Boston. From there, I enrolled in Boston University. Mm-hmm. And that's when I started meeting people that were actually in the investment business. And I met a really good friend of mine at that time. We went through our entire career together, MBA career. And he said, why don't you come over to Liberty Mutual and apply for a job in the investment department? And so I did that, and I started working there. And that was, to me, really my first sort of entry into, investing.
So I'm assuming at Liberty Mutual, what you're investing is the firm's own capital from the insurance.
Right. It's the
proceeds.
Pot of money
Right.
it's the insurance money.
What was that experience like? How did that affect how you approach fixed income today?
To me, it was sort of the boot camp for fixed income investing. So we were a pretty lean group of individuals. By nature, most of us are research people, and we were giving corporate, insurance companies do a lot of corporate investing. So we each had our own sectors. I took on the banking sector, which was interesting. I had a number of other things as well. But we also traded for our sector. So we had an empty trading room, and the TART phones were in there. If you wanted to trade, you say, hey, fellas, I'm going to go do some bank trades. Come on in, and we'd call Wall Street, and we'd do the trades right there. And when we're done, we would go back to our research. And I also dabbled in a little portfolio management at the time. I ran a Mexican peso denominated portfolio, believe it or not. So it was a really great boot camp. And, I had a really interesting manager there who was really disciplined people in terms of research. It was deep dive research. We did a really good job.
Huh, really interesting. So from Century Bank to Liberty Mutual, the rest of your career has been primarily on the fixed income side. Right. Was that happenstance by design? What led to that outcome?
I think it just was a natural fit for me, with the training as a commercial bank analyst, and then it just really kind of fascinated me more. And so I think, my skill set when I was, approaching employers, it just naturally gravitated towards the fixed income area. And for me, surprising to say, it's a little bit more exciting than stocks. I mean, stocks are interesting, but there's so many different facets to fixed income. It's become much more specialized. But I'm fortunate I span a lot of different areas, my career, which has been
So
great.
Let's talk about that. So not only are you head of the full discretionary team, and we'll get to exactly what that means in a bit, but you run 10 different mutual funds and 10 institutional strategies. I assume there's a lot of overlap, and it covers the spectrum of fixed income from treasuries here to high yield there and everything in between.
Everything in between globally. So we're kind of an eclectic group, in terms of investment style. It sounds like there's a lot of strategies that we do, and that's true. But really, there's the same common investment engine underneath it, and that's really what we're focused on. I spent most of my time on that. And what does that mean? It means the frameworks and the investment processes that we put in place provide the raw materials for investing. That's views on rates, where do you want your duration to be, et cetera. Views on the value in certain sectors, views on individual securities, so that's the raw material that we get, and then we can mix and match that to our various portfolios. Most of our portfolios, really, it's a spectrum, just kind of think about it. And it's a spectrum for, I would say, lower risk to a higher degree of risk. That's usually, but not always, defined by the quality that you can invest in. So as you go down, more non-investment grade, for example.
Huh. So I like the idea of this engine as the underlying driver of all these different strategies. It's not that there are 10 completely novel approaches and 10 different funds. It's really the core, and you're just playing with how much returns you want and how much risk you have to take to get that, what sort of duration you're looking at, what sort of geographies. But the underlying engine is the same across all these different portfolios?
That's right. And, we can expand that risk depending on the client. And so when you look across our least risky range, we run a really great Core Plus product. It's a bit more out there than the typical Core Plus that you'll see. Mm-hmm. In other words,
Core Plus meaning treasury,
corporates, but we don't do, for example, we don't do a lot of agency. We don't know agency mortgage-backed securities. We definitely tilt into corporates. That's our bread and butter, what Loomis is known for, our research. And so that'll have, the least amount of risk, let's say, relative to, say, a multi-sector bond fund style portfolio or strategic income. That's going to tilt down. But when you look across those, you'll see commonalities in terms of interest rate positioning, names, exposures from a top-down and a bottom-up perspective.
So you are now the head of the discretion team. Tell us what that means. Certain funds have discretion, others don't. I think the average layperson is not familiar with discretion in that context.
The business sometimes does a poor job of labeling things, and this is no different. And I the way I kind of describe it is that, a more constrained approach is typically something wrapped around an index. And a lot of our competitors in the Core Plus space are like this. They take a benchmark. In that case, the aggregate index is by far the most common one used. And they'll have a very low tracking error of that. They'll just ebb and flow with pretty much the beta that's, assigned to that, with maybe generating a little bit of excess return for the good managers that are there. When you start to get into something that has full discretion, the client says, okay, let's sort of go or lean into your opportunity set, where your skills are. Let's allow you to do more and have a wider degree of risk and off benchmark in your sector. And that's where that full discretion notion. So when you think of Core Plus, it's those plus sectors, non-investment grade, emerging markets, things like that somebody was looking to you to have discretion. But full discretion doesn't mean you don't have any limits, right? We all have constraints, right? There's always constraints.
So the phrase I always hear is it's an unconstrained fund. Right. What's the difference between constraints and discretion, or are they just really the same terms?
To me, they can be used interchangeably. I think the nomenclature typically, when I started, and multi-sector, for example, has changed. We run the bond fund, which is kind of a go-anywhere strategy or strategic income. Those used to be called multi-sector, even before they were medium grade or something like that.
See, today when I think of multi-sector, I think of corporates, treasuries, high yield, equities,
right,
and privates, including private credit. All that seems to be multi-sector unconstrained.
Yeah, this is where the nomenclature changes over time, I've known, and it causes some confusion. And then, what emerged too, and I launched one of these over 10 years ago, was that unconstrained or non-traditional space. That was the,
right.
What's the difference between unconstrained and multi-sector? Well, there's not really that much difference. The unconstrained typically does not have a benchmark. That was one aspect of it. So
does that mean it's an absolute return fund?
Yes.
So
and
you don't care about relative performance.
And what's the difference between absolute return and total return in some ways? Because like the bond fund, we're looking, I don't really manage on a tracking error. I don't like managing on a relative return. But let's say, oh, Mr. Client, we outperformed. Your index was down 10% and we were only down 9%. That's not really a great outcome, right?
Right.
We're looking to make money, and that's absolute return or total return, whatever you want to call it. That's what we're
See,
able to do.
we talk about jargon and confusing labels. To me, total return on the equity side is equity plus dividends.
Right.
As on the bond side, it means something else.
Income.
Right.
Income
That's right.
and principal return.
That's right. So you've spent more than 27 years at Loomis Sayles and Company. That's rather unusual these days. What has kept you around so long? What's it like growing with a firm that's been in business? You're coming up on 100 years.
Sometimes you're looking and doing your job, and then you wake up, you look up and wow, I've been here this long. It's been fun. I've enjoyed it. When I first came to Loomis, I encountered this guy named Dan Fuss. And to me, it was like a duck to water. I just took to his style. I can't imagine doing investing any other way. It just suited me to a T.
And he is a little bit of a legend, isn't he?
He is a legend, yeah.
He's been around a while. And how long did you work with him?
Well, the funny story, when I first came to Loomis, I was interviewed. There was a sort of an arms race for research analysts on the street, on the buy side at that point in time. Wall Street had tons of research analysts, but the buy side was really ramping up, and I had a lot of opportunities to interview. And one of them was at Loomis Sayles, and I got the job. And a fella helped me, this guy, Dan Holland at Goldman Sachs, was instrumental in helping me. And so I got the job, and I'm like, there's this guy, Dan Fuss, there. And I don't really know him that well, but he's 65, let's say, at the time. I said, I don't know, it seems like he's really a marquee part of that firm. Maybe there's a risk there. And Dan told me, it was great advice. He said, Matt, 5 years is an eternity. Take the job.
Right.
So many eternities later, because Dan is still working. He's 90.
Really?
Yeah, he could still come to the office.
God bless him. Wow.
He stopped managing money a while ago, but never did I expect what was to come. And nor did I expect that I would become a successor for him. That was the entry point. And I'll tell you a story, but when I first came there, it was 97, 98. Okay, the Asian crisis was just getting going. Remember, the Thai baht devalued. It went down like 50%. And, LTCM was going to hit
Next
a Russian
year,
default.
Right.
And so it was, bonds were coming out. And back then there was the Brady bond market was still big. Brazilian C bond was the most liquid bond in the universe. The market was going down, and I witnessed Dan with a big smile on his face in the trading room in the morning meetings. I'd go there, and he would be snapping up all these bargains.
Right.
Our portfolios went from, close to zero in the Asian market to reaching, like we're talking about constraints, reaching the limits that we could do specified by the guidelines at 30, 35%, right? And so that was a huge lesson for me. First of all, I said, this is where I want to be. What he was doing there was providing liquidity to illiquid markets. Now, I participated in some of that as a research analyst by looking at companies like Total Access Communications, a Thai wireless company, PLD, Philippine Long Distance Telecom. It's like AT&T.
And all these companies have fixed income bonds.
All they had
out
fixed
there,
income.
and they're trading way below
cents
par.
on the dollar.
Right.
Cents on the dollar. In the case of Total Access Communication, bought the stock at 11 cents, went to 5.
Went to 5 cents or $5?
$5.
That's a good
Excuse
trade.
me. Yeah, I should have specified that. So these were, like in my formative stages, like as a research analyst, and becoming, not just a research analyst and making calls or, sort of opining on the credit quality or the opportunities and risks of a particular credit. It's really becoming an investor. And that's sort of what Dan taught me.
I love the expression providing liquidity to illiquid markets, which usually means picking up things at fractions of their actual value. The same phrase was during the financial crisis when people talked about toxic assets, and my answer was always, there's no such thing as a toxic asset. Right. There's only a toxic price. At the right price, everything has value.
Without a doubt. And it introduced me to sort of that concept of margin of safety. A lot of people talk about it. But with bonds, it's really interesting, particularly corporate bonds. As the dollar prices come down, your risk goes down because there's a recovery. In the worst case scenario, you end up, owning the company basically, right? So the recovery value, and sometimes those recovery values or the trading value come close to, or if not below, the actual recovery value in those situations. So, because like a quant person would come in and say, oh, your value at risk is going bonkers right now. Vol of your portfolio is 9%, and
they've got it backwards.
It's like, no, this is the time you want to go. And in fact, at that point, the returns are skewed in your favor, the forward-looking returns.
Really fascinating.
Yeah.
So let's talk a little bit about the team you work with. You're head of the full discretion team. What does the team do? How are they working with various funds and strategies? And how do they work with clients?
Right. So we're managing roughly about $74 billion in fixed income portfolios. We have 4 main product categories. I talked about our Core Plus offering, which is our largest, over $28 billion. And then it goes into sort of multi-sector. And then after that, you're into the high yield. We do all our dedicated high yield and bank loan investing as well. Like I said, we're pretty eclectic. We tend to not look like our benchmarks. We have a lot of discretion to go outside, and we're really interested in just generating the best total returns we can from a very wide opportunity set.
Really, really interesting. You talk a bit about various strategies across all the funds. I want to dive into these and get a handle on what they mean. So I often see the phrase research-driven, bottom-up approach. I assume that means we're not making big macro calls. We're looking at quality. We're looking at duration. We're looking at risk.
Right. I mean, it's hard to get away from macro calls altogether. Fixed income portfolio, for example, duration is a big call you got to get. But, a lot of our alpha, our so-called excess total return, is driven by our bottom-up security selection. And that comes through really excellent research. When you look at our process, we do think about a macro. We are credit cycle investors. As I said before, we lean into the credit markets. Where we're going to make our money is tilting into risk. So for us, most of our intermediate quality is going to be BBB average quality of our portfolios. So
that's a little below investment grade.
Yeah, and we think that it really makes sense to tilt in through the cycle, okay, to get that spread premium. You get compensated for it as an investor. Maybe it's only 100 or 200 basis points, but compound that over 5 years, you got more than double the money. It's significant.
Yes.
The key is to avoid permanent losses, and that's where the individual security selection comes out. We tend to be concentrated in those, so when we find something we like, we'll buy it relatively big size. Not as big as, say, a 40. When you look at the stocks, you might say something like a 35 stock portfolio. You can't do that in the fixed income. You got to diversify more. But that's what we seek to do.
Opportunistic we'll get to. Value-driven, that is so interesting on the fixed income side and so different than what people mean when they say value and equity. What are you getting paid for the risk you assume in fixed income? Like if we look currently, especially with an inverted yield curve, you're not getting paid a lot for a very long duration, but there's some risk with very short duration that, hey, if the Fed decides to eventually, one of these days, cut rates, well, your short-term duration, now you have reinvestment risk. How do you think of value relative to fixed income?
You're bringing up a point. There are a lot of different types of risk premium in fixed income, more so than there are just in the stock market. And that's interesting because you can build really interesting portfolios that have different risk factors that co-vary very well together. In other words, not perfectly correlated. So that's diversification. So let's just focus on the interest rate risk premium that you're talking about. You bring up a good point here. So first, and I learned a lot of this from Dan, but you think about this, let's take a big step back about interest rates. We all know for a long time, your concept of reinvestment rate risk and principal risk are the key big picture risks that you take in fixed income. For many decades, after the Paul Volcker slayed inflation, your biggest risk, people really didn't understand this, but your biggest risk is reinvestment rate risk. Right,
especially when you're in a 30-year market where rates continue to fall. I remember my father-in-law saying to me back in 2000, he had a bunch of NYC GO bonds that were 15% when New York City was in trouble. Right. And he's like, what can I do with this? I'm like, we get 6.5, 7 on a treasury. He's like, 7%? Why would I want 7%? Right. Well, it's going lower. We'll talk in a few years, it'll be 5%. No, can't be. Yes.
Yeah, so rates came down more and more than people are expecting over time. And, it's interesting. Dan used to run a 10-year duration in his portfolio. That's, for people to know, that's very difficult to do. You have to buy basically 30-year zeros to kind of get you out there. And he was doing that in the Canadian bond market, zero. So it was very interesting. People ask him, well, you don't manage duration. It's just sort of an artifact of your portfolio. He's like, no. I want to maximize that because I want to capture this yield for as long as possible. Don't worry about the cycles because you're going to have lower lows and lower highs. And that persisted until about 2003 Remember the conundrum, the bond conundrum?
Right.
Rates started getting really low. We were kind of, back then, even approaching the lower bound.
That whole excess savings nonsense we heard from, at least I thought it was nonsense. Fixed income people might have a different view.
And so then you had to get to a point where you start, okay, now you have to start considering the principal risk. Now, it took a long time before principal risk has become a problem. But I would say even before the pandemic, there were signs that you needed to start flipping your calculus as a fixed income investor on a secular basis.
In other words, saying, hey, we've been at zero for a long time. Eventually, rates are going to go up, and I would rather be sooner than later, because if I wait too long, especially with long duration, rising rates in long duration fixed income leads to capital loss.
In 2020, the 10-year was 50 basis points. We ran a very low duration there. And you're going to say, well, it wasn't a big risk because you were at the zero lower bound. What are the chances they're going to go lower?
And you weren't getting paid for it.
And you weren't getting paid for it. Now, that seems like an easy decision now, but not necessarily at the time because people weren't sure. But that was a really good call for us. And before you used to be able to ride, like Dan did, the 10-year, you could just stay long. You cannot stay short.
Right.
In this market and expect to do well over the long run. You've got to manage through the Fed cycle. So I like to think about it as a Fed cycle. I think we're, obviously coming to a cutting cycle soon. Your risk now on reinvestment rate risk is in the short end, and I think it's time to kind of move out into the intermediate of the part of the curve.
I totally agree. Yeah. We've sort of taken the same approach internally. Let's go over the rest of your core principles for the key strategies. We briefly mentioned multi-asset. Does that include equities? Does that include private credit? How multi is multi-asset?
Multi-asset does include, for certain portfolios, the more risky portfolios, we can start putting in stocks. Our most risky strategic income, we can do up to 35% stocks in that portfolio. Then you go into something called global allocation, which I manage the bond sleeve, but with a couple of great equity managers and a great global manager on the fixed income side. That is typically like 70% stock. So we do bottom-up stock selection as well.
So in your multi-asset where you're looking at the equities, is it a particular type of equities? Are you looking at dividend payers? Are you looking at convertibles? What sort of equities complement the fixed income side and the multi-asset?
Yeah, you bring a good point. Equity premium can be gotten from not just stocks, but also from converts.
Yeah.
Right. So we do that across all our portfolios, right? Even ones that don't necessarily allow us to buy outright stocks, we can buy convertible bonds, and we've made hay in that market because I think it's less efficient. So
it's a challenging space because if done right, you get the best of both worlds.
Yes.
And if done poorly, it's the worst of both worlds. Hey, low yield, but at least there's principal risk. Who wants that?
Well, it's the only kind of bond that's a growth bond, too. So if you're right, you're really right. And we've had some really great winners like Corning over the years.
Well, if the underlying, if the parent company has some positive corporate event, well, obviously the convertibles do really well. And some of them have, the terms that say, hey, well, this is going to convert at this low price. When the price is up here, it's a win-win, other than having to pay the taxes.
Right. So we do that, and we're very good at that, always have been. And on the stock side, we're fixed income investors. Our investors expect us to generate yield. So that pushes us into the dividend-paying stocks for the most part. I would say from a bottom-up perspective, our research group does a tremendous job at uncovering value. What I ask my analysts to do is really understand what the assets of a company are worth. Okay, this is our fixed income analyst. This typically, you think of equities. But
meaning event of a default, what do we end up with as?
But what is the value? Because then I can look at the cap structure and I can say how well is that debt covered. And then I can have a view on the stock too. So oftentimes where we see the best value is that in the equity market misses it is when a company is going from, say, a low quality, but is all of a sudden moving up rapidly from a credit fundamental perspective. That starts to accrue eventually to the stock. It sort of goes from sort of worry about the leverage to, we're not worried about it. The risk premium starts to come down the stock and it starts to inflect.
So when you're doing your fixed income corporate analysis of bonds, you can also identify mispricing on the equity side?
Absolutely, yes. We see it all the time.
That explains this sort of pet thesis I've had for many, many years. A lot of my favorite equity analysts began as bond analysts or are bond analysts with opinions on equities. And it's very different than the equity side, perhaps because of that exact reason. They're really in the minutia of cap table, the corporate structure, what the priorities are, and that really seems to provide a lot of insight into what is this company really worth going forward.
I agree. We see it all the time.
So let's talk a little bit about your clients. Loomis Sayles manages well over $300 billion, $340 billion. Who are your clients? I know they're primarily institutional and they're spread out over 20 countries. Is it U.S., Europe, Asia? Who and where are your clients?
The most of our asset base is in North America, as you would expect, being a U.S. manager. But we've expanded both in Europe. Asia, I think, is our biggest pot of money outside of the United States. So we're pretty much everywhere. We have offices now in Singapore, for Loomis offices in Singapore and London, and that's something that's grown as I've grown over there. It's been fun to kind of expand internationally. Of my client base, half of it is retail. We're either doing our own funds or sub-advising on that half, and so we're dealing mainly with the big wirehouses like the Merrill Lynches of the world, et cetera. The FAs are investing in the funds. That's for the most part. RIAs too, places like that. And then on the institutional side, we do, of course, all private pensions, sovereign wealth funds, public pensions, Taft-Hartley plans, insurance, all of that.
Huh, really interesting. How often do you get to London or Singapore?
I go to Asia. My wife's from Sydney. I was just in Sydney a couple of weeks ago. Interesting contrast between the U.S. and Sydney right now. But
why is that?
Well, this goes back to the Fed and the transmission of policy. Here in the United States, what's the average mortgage now is like a 3 handle?
Yeah, so if you look at the pool of mortgages, 5% or below, it's like 65, 70% of all outstanding, whereas most of the rest of the world is variable, not fixed mortgages.
That's just it. So that transmission is muted on the upside for when they're raising rates for the Fed. On the downside,
refinance.
I refinanced a mortgage once a long time ago before I made one coupon payment. But so there's a sort of asymmetry. Now, when I was over in Sydney visiting family and doing some business, you talk to people there, their mortgage bills is hitting their pocketbooks right away.
Right.
A little bit of a lag, but it's killing them right now.
Right.
And, inflation is tough there. The same themes here are there, but you can start to see it more there.
Is that why we've seen who's cut rates over the past few weeks? The Bank of Canada, Bank of Australia, right?
ECB. RBA has not done that.
They have not yet.
Yeah, and they're even talking about raising because inflation is still a problem there. Now, the difference there is they got way more immigration.
Right.
And it's a growing population. You talk to a developer there. They have the same housing problem.
They just can't keep
space,
up. Right.
And you can't find skilled laborers to do the job. So that's where the similarities are.
But still a robust economy that's doing pretty well.
It's a robust economy. Yeah. So Australia's always been like that because of that growth.
Right. Plus they have China. They're a giant supplier to China for commodities, everything else. I would love to go to Australia. I am just so intimidated by that flight.
It's a long flight.
Right? It's like 18, 20 hours, something crazy.
You
like
bring
that.
a good book with you. Yeah.
You got to bring a couple of books, a couple of movies, and some sleeping pills, and you're halfway there.
Right.
It's really tough. All right, so across your career at Loomis for 27 years, you have gone from analyst to portfolio manager to head of the full discretionary team. Tell us what that transition was like and how you were able to relate with some of the younger analysts in the firm, considering you started out where they did.
I kind of got lucky, and there was an opening as a portfolio manager, and I had spent only 3 years in the research group. I was sort of snake bitten as an analyst. Anything I touched as an industry seemed to blow up. But when I came to Loomis, I was covering oil and gas when oil went to $5 a barrel,
right,
or $10 a barrel, something like that. And then I also covered
$8 a barrel. Yeah. I want to say late '90s, something like that.
Right. It was late '90s, and on the cover of The Economist it said $5 right. And I'm like, that's the bottom.
And that was literally that. So it's so funny you say that. I sat in on a meeting. I won't mention the firm, and listened to the market strategist / managing partner scream about $2 and $3 oil. Yep. And I leaned over to the guy next to him, and I'm like, you will never see a lower print of oil in our lifetime. Literally read the same nonsense that this guy was spewing in Barron's that week. And I'm like, gee, this sounds kind of like the opposite of what you get at the tops in equity markets. That's it. Oil is bottomed. And That was
Sure enough, it was, yeah. And so we made some good money. We made tons of money at Chesapeake Energy back then. And the Asian crisis, I made a lot of money with Dan in the trading desk at that time. I also covered wireless telecom, so that entered into So anyways, I had a lot of swings there that went really well. And I was asked to manage money with Dan, and I didn't expect it at that time, but it just happened. And so I fell into that. Back then, it was a lot different. You ate what you killed. What I mean by that is you were loosely affiliated as a portfolio manager. I basically would hang my name up on a shingle and say Matt Eagan, portfolio manager, and a client would hire me, right? Not necessarily Loomis. And we were loosely affiliated around like the Dan Fuss style. And I love the Dan Fuss style, so I was investing like that. But my first opportunity as a portfolio manager, you had to go where other people didn't want to go. The other senior managers didn't want to go. So an opportunity came up in the middle of January to go to Helsinki, Finland, for a high yield opportunity, and I raised my hand.
In the middle of January.
In the middle of January, which is quite interesting. It's very cold
and very dark.
And I went there and I got it was like $200 or $300 million mandate for high yield. So that was great. At the same time, we started institutionalizing as a business because Loomis was really created as an investment counselor. Back in the day, the manager did bonds and stocks and worked directly with that client,
right,
one-on-one. And we needed to institutionalize. When I first started Loomis, we were $80 billion in AUM. And we were growing, right? So now we're almost $350 billion. So it's been a lot of growth. And that's one of the reasons growth creates opportunities, right, for people. So we need to institutionalize. We hired a new CIO came in to help us do that. And we created teams. And that's when we started to create the team that, Dan was on, I was on, Elaine Stokes. Everybody's retired except for me off of that original team. From there, I started creating that product team that you see over 20 people today. We institutionalized the products, the product offerings, which really makes you think about how do you explicitly state what the objectives are, right? And then we institutionalized the framework. And I think behind every great shop, equity, bonds, whatever, behind every great manager is a great framework, a repeatable framework. That's the hardest thing we did.
Developing the process that you can do over and over again.
We had the foundation. We had it up in our brains. The idea was to put it on paper and write it out. And that took a long time. And then, of course, succession for Dan was a huge part of my role.
So let's talk a little bit about what you describe as the Dan Fuss approach. I love the concept of opportunistic investing. So a few questions. Let me just start with explain what is the Dan Fuss approach?
Before I answer that question, let me just describe, a situation when I became a portfolio manager. I was a credit guy. I was a credit research analyst, and I really liked high yield investing. And, Dan was covering all these markets, and it looked really daunting. I mean, when I say everything around the globe, he was reading, Asian papers. He was covering Canadian bond markets and all the Aussie bond markets, et cetera. I said, maybe I can just do high yield. I said, Dan, I think I just want to focus on our high yield portfolios. What do you think about that? And Dan said, you're not going to get away with that.
Too easy.
You're not going to get away with that. So you are going to be a better investor. Trust me. You're going to be a better investor if you can cast a wider net. So that's one of the first things. Cast a wide net. Okay, so I said, all right, how does he do that? So what I started observing him, and what people who know Dan very well, most of the times to this day, he still does this. He stands up in his office, and there's a sort of a table that he's at, and he charts things by hand. He charts commodities, bond prices, stock prices, all of these market information. So I asked him to show me this, and it was done on green ledger paper, the old green accounting paper. And he started flipping this thing open, and it just flipped page after page after page. He has a slide ruler that he says he used to scratch his back and also to do straight lines. And I said, wow, right? I said, why do you do this? He said, I learned through the end of a pencil, okay? And what it does is it allows you to connect disparate spots and connect points that seem unconnected. And then you see that they are connected, right? And that's how you learn as an investor. So I started doing that. I did it through spreadsheets. It's different than just looking at a chart. You pull up a Bloom chart, you look at it, right? It doesn't stay with you as well. Another method is actually either writing it out or putting it into a spreadsheet and looking at the data over time and tracking it. Economic data, GDP data, employment data, bond prices. Auction. I have auction data going back on a spreadsheet back to the 2000. So that helped me become a multi-sector investor.
Huh. Really intriguing. Yeah. I took the technical analyst course in the 90s with Ralph Acampora, and I had not only heard something very similar from him to what you're describing with Dan, but a number of traders and fund managers and technicians all had said, I like the expression learning from the end of a pencil. Looking at a chart is not the same as drawing a chart. You end up feeling something viscerally that you can't get just by visually viewing it, especially when you're doing it every day with a whole run of different assets. What you begin to feel is a real rhythm, a real intuition as to what's going on. It may look random and often is, but when you're doing it manually day by day, you kind of get a sense of what's happening.
Yeah, in fact, it's your intuition that everybody talks about. You start to build this kind of intuition about the market and these funny feelings that something's going on, under the surface. And then, I like to listen to that, and you start sort of unpeeling that, and it leads you to start to focus on areas that maybe other people aren't focusing on.
That's the art, not the science.
That's right.
When I think of opportunistic investing on the equity side, it's very much buying when there's blood in the streets, taking the opposite side of panic. It's a little harder at tops than bottoms. Bottoms are very visible. Tops are this long, slow process, but it's really visceral and emotional, and people are panicking, and I'll make a little liquidity over here. What you described in terms of opportunistic investing on the fixed income side seems somewhat qualitatively different. What is opportunistic investing on the bond side?
Well, I think it's similar. I mean, like I said, we provide liquidity to illiquid markets, so we're looking for dislocations in the market, and that because of greed and fear, or differences in timing of horizons of investments. For the street is very short. We can be longer. I think for the temperament, for my style, I think you have to really enjoy volatility. Mm-hmm. I notice that I'm smiling when the market is down. And I think that's an important kind of trait to have. I get antsy and kind of more grouchy. Unfortunately, a lot of the times you're in these markets where they're just kind of going sideways and there's not a lot of value.
Right.
That makes me grouchy. I try not to bring that home, but
grouchy, or is it just boring?
It's boring, which makes you a little bit irritable, And I think I really enjoy. I probably would have been a good ER doctor. I like it. In 2020, we're in the pandemic, right?
Right.
And that's going on, and you can buy McDonald's at 70 cents on the dollar. I love that kind of market.
That's hilarious. I remember in the middle of even the early months of 2008. And after being kind of a goat for a year, saying, warning, hey, it's coming. I don't know exactly when it's going to start, but you could see this can't last. In 2008, I used to play Free Falling by Tom Petty on the computer. And one of the older senior people said, listen, I understand what you went through, and you're finally getting a little comeuppance for everybody who doubted the analysis, but people are getting fired. There's blood in the streets. You got to take it down a notch. So that like smile is like, okay, you got to kind of
exactly.
Got to kind of keep it on the inside. But when I was younger and dumber, I didn't realize that. Now I'm older and dumber, and I kind of figured some of that out. So let's talk about the state of the bond market. You and I kind of began around the same time, around mid-90s. We were the beneficiary of Paul Volcker's breaking the back of inflation. For anybody who has been working in markets for most of the past, 40 years, rates primarily trended downwards. How does that impact how you think about fixed income? Sure, there have been occasional spasms upwards, and we'll talk about the 2020s next, but what does that framework do to how you were running a bond portfolio in a multi-decade-long bond bull market?
Right. Well, of course, we went into the QE years, and you had to look at what QE does is it pulls real rates into the negative market, and the Fed basically tells you do something else, go buy risk.
Right.
During those periods, you just had to follow what the Fed was doing. And if they were providing liquidity in the market, you could feel pretty comfortable taking risk.
And that's literally the past 20 years. You got to go back to the 2001 recession, and then September 11th, we were pretty close to zero for decades.
Yeah, so the bond market really changed during that. You remember, you used to earn, you used to think about the yield curve under classical thought processes, what the Fed's doing, what the economy's doing. During those QE years, you just worried about what the balance sheet of the Fed looked like. Is it expanding or contracting? And that pretty much told you what to do, really. I think QE now is sort of in the rearview mirror for now.
Right.
I don't think it's going to come back. I think we're in a different type of market where people who have not witnessed an era where inflation is driving more decisions, I think you really should look, at longer history. I was telling some of the younger people, do not try to expect to extrapolate what's going to happen based on recent, I'm talking decade or two type of bond markets.
Mean reversion doesn't mean going back to zero. It means it goes to 5%.
Right. So I think that, it kind of goes back to that concept we were talking about, reinvestment rate risk and principal risk. Now going forward, your biggest concern or your challenge, and it's manageable, is how do you preserve principal while getting to a higher level of yield? So you think of in today's market, used to be we were walking down a steep staircase. It was going down, down, down. Now you're looking at steps going up before you, I believe.
Is that the new trend?
I believe it is. I think we can talk about that. There's a structural feature to this market that's going to keep it higher for longer, let's call, at least over the next decade or so. And then there's a cyclical component, which we can talk about in a moment. But the structural components there are tailwinds to inflation. And the biggest driver is the fiscal deficit.
I was going to ask about that. We've had this giant regime change that during those 20 years, the prime driver was monetary policy. Right. Now it feels like not only do we have a massive fiscal stimulus, first with the tax cuts under Trump and then CARES Act 1 and 2, which were giant fiscal stimulus, but now you have CARES Act 3 plus all of these 10-year-long, the infrastructure bill, the semiconductor bill, the inflation reduction bill, whatever the name of the bill was that added a whole bunch of money to the veterans hospitals. And those are all 10-year ongoing fiscal stimulus. Is that what you mean when you talk about?
Yeah, I started, this actually really predates the, when I started thinking about this. For example, I was always asking me during those QE years, what fundamentally needs to change for us to start thinking differently about structurally where rates are going? Because we were starting to see labor market conditions tighten. Remember around 18, 19, the Fed was starting to, it started going the other way.
Q4 18 was a major drawdown in the equity market, almost 20%.
Yeah, and so you could see wages were just starting to lift up. And all of that was hidden by the pandemic after that, but there's a tightening in the labor force underneath all of this. And that's the demographics. I was reading the Great Demographic Reversal at that time by Goodhart et al. It was talking about the aging of the population. People used to think aging of the population is deflationary. Well, he put a different spin on it, and it kind of got me thinking. And the big thing there is globally in the industrialized world, this is true.
Wait, the aging of the population is deflationary or is not?
It is not.
So the traditional discussion is people get older, they stop consuming as much as they do when they're younger. They already own their house, the mortgage is paid off, they own their cars, they'll drive them forever, and that's somewhat deflationary. What's the counter?
Well, he talks about, it's really about the working age population. And if you looked at the big event that we had was the ascension of China to the World Trade Organization around 2001 or something like that. They brought 800 million people to the working age population. So our wages in the developed world were crushed on a real basis. So there was sort of stagnation in there. And their wages grew in the emerging markets. They became richer. Now we all know the story now that China's population is rolling over now.
Right.
And globally in the industrialized world, the working age population is kind of stagnant, and that's the tightness there you're seeing there. The people who spend are the young folks and the older folks. In the middle, the working age population is where the saving takes place. So as you age, you actually spend your wealth. And so that's what's going on, I think. There are a lot of people who push against that theory, and I understand a lot of that. But I look at it anecdotally. What did we see? We saw, some unionization efforts happening in this country for the first time. I mean, it's small, but on Amazon and so on. And we can feel it, in our spending. Wages, haven't necessarily kept up with this boost in inflation, but they're continuing. So that was one aspect of it. The other thing that was going on, and Trump was, really started more or less a trade war with China. trade had been sort of, you had the chimerica, you all understood that. It worked well for both parties. Now we're in a situation where it's not working well. Mm-hmm. There's tensions there. Security concerns are rising, have risen. So now you have nearshoring. You have chips war, things like that. You have defense spending going up. So all of these things are adding to that inflation. And then on top of that, you have electrification through climate change and other factors, EVs, all of that stuff.
What's the impact of electrification? Which I saw a chart this morning that just showed China's electrification has just blown everybody else away. They are moving towards full electrification faster than anybody else by an order of magnitude.
Right. They're winning sort of in the battery and the EV space. We know that. They're leapfrogging in certain areas where they can just sort of jump technologies, if you will. That happens a lot in the emerging markets. So the electrification, though, in the United States and the developed world, it's all about the grid and how, we've got to get our grid able to handle all of these EVs, all of the electrification that's going to take place. And that's going to require just a massive amount of investment and also stranded assets down the road. So you add all of these factors, I think structurally there are tailwinds to inflation. Now, what I think that means, what the consequences of that is that inflation will be unstable. And so you'll have cyclicality inflation. Think of it as like the sawtooth where the teeth become, steeper. You probably remember this. You have more variability in the economic cycle because what inflation does is it adds uncertainty to consumers' spending. It adds uncertainty to planning for businesses. And so you get these fits and starts. It's a more compacted business cycle. It makes it difficult or trickier for the Fed to deal with. Mm-hmm. So I think that's what we're going to see. This last cycle was really weird, and I think we're going to see more of these types of cycles. And so I just think you need to have that in your brain about how this market's going to behave. And, we can talk about the cyclical component of that today and how you play it in the near term.
The big counter to higher for longer that I keep hearing is, the things that are bringing rates down hasn't been higher interest rates because of the lack of pass-through in the housing market. Although it is impacting the bottom half of the economic strata's credit spending, it's costing them more. But wherever we look, we see these structural shortages. So you mentioned how tight the labor market is. A lot of that is a reduction in legal immigration, not just under Biden and under Trump, but going back about 10, 15 years, that kind of post 9/11, we tightened our rules. Some people have said the entire jobs growth over the past few years has been primarily immigration. Giant shortage in housing in the United States, mostly because since the financial crisis, we pivoted to multifamily homes and didn't build enough homes to keep up with population growth, and suddenly there's a giant surge. Even things like cars and a shortage of semiconductors and how long it took to get all that back online. We haven't had enough automobiles out there. That's what's elevated prices. So that's a long-winded way to say, how much can the Fed influence this current cycle of inflation when it's driven in part by so many things that are responsive to policies outside of the Federal Reserve?
Yeah, and I think that's been their number one problem here, and there's been supply side issues. I know you've talked before about the housing market. You raise rates and then people stop building new homes, and how does that impact the supply of housing? It's
right.
It's counteracted.
Raising rates makes inflation higher. Seems sort of weird.
It's a weird situation. I think all of that is true. I do not know for sure that we're structurally on a higher for longer type of scenario, higher highs and higher lows. That is the way I think you should bet right now based upon what I see. Other factors that I think are going to, particularly on the demographic side, what about AI, right? How does that affect, productivity, the productivity mirror? To have
outside of the AI companies, the rest of the marketplace?
The rest of the, how does it affect wages? How does it affect productivity? Can you actually have rising wages and rising productivity and growth without, wage inflation? Because if you don't have wage inflation, it's tough to get kind of like a more of a sort of a spiral of inflation.
Not a structural inflation.
Right, it's not structural. So if you start, those things start to fall away, you kind of have to say, maybe we're back to a 2%. I think it's not. I'm not talking about a reverse. I saw the 70s as a young person. I know what that's. I'm not suggesting it's going to be like that, but I just think that what's important for a bond investor to understand is that inflation, which was stuck structurally below 2, is going to be above 2 to some level. How much I don't know, but I think it's going to spend more of its time above there. Higher for longer, in my mind, means higher real rates and higher inflation premiums for the uncertainty of that inflation. So what does that mean? I think, for example, like on the 10-year today, like long term, maybe fair value in the 10-year somewhere around 4.5%.
So that would suggest now is the time to start lengthening duration if you haven't already?
Yes, and with a caveat that I think this is going to be a shallow rate cutting cycle. I think they start it sometime at the end of this year, would be my expectation. I think the economy cyclically is losing momentum.
You're seeing it on the consumer spending side starting to drift lower.
Retail sales, there's a lot of problems with the job data that I can't even want to go into. It's hard to trust that data, but when you look at claims data, but even when you start digging into the job data, you look at permanent job losers rising. You see, part-time overtaking sort of full-time. So on the, this is not a big correction. Let's face it. Unemployment is really low, but on the margin, you're going to see that deceleration.
It's a robust economy, but cracks are starting to show in the foundation.
And, like you always say, like people are not going to know let's say you go into a recession. I don't think it's going to be a full-blown recession. Those numbers are revised. Like it's funny to me that we spend so much time, job report Friday comes out and everybody trades all over the number.
It's the most important number of the
month. And a year later, all of those numbers are revised in a big, big way.
Yes.
And you'll often see, we actually were losing jobs in that period of time. I don't know if that's going to happen. It can go both ways. It can revise to the upside too. But I do sense my sense is that looking at the tea leaves out there that we're decelerating.
If that's the case, then I have to ask you to put on your Fed chairman hat and say, what are we waiting for?
I think the Fed has been jawboning rates as they want to see. Yeah, they've been jawboning. So remember, they last November timeframe, they did the dovish pivot. I think they did that to get ahead of the election cycle. I know people say, well, the Fed doesn't respond to elections. I talked to a prominent Fed chairman, says, in a weak moment said, you kind of have to take that into consideration. I do think they're political animals at the end of the day to a certain degree.
Although they have raised in previous elections.
They'll do what they need to do.
They've done rate changes in prior election years.
But this election is a big one, right? And so I think they just wanted to be out of the way, and then they could be in a position to jawbone the rates because they knew they had done a yeoman's work already to reduce the spike in inflation to get down to that beginning of the last mile, so-called last mile. That's been more difficult than expected. We were thinking that as well. We faded that bond rally in the fourth quarter. The curve, I think, it's a shallow rate cycle. Most of the rate cuts are going to come from the front end of the market. Remember, the Fed controls the front end of the market out to the 2-year, maybe even a little bit in the 5-year. After that, it's
all the bond market.
It's all the bond market, particularly the 30-year. It's its own beast. It runs to supply and demand. I don't want to get stuck the long end, especially going into this election uncertainty. So I think you don't want to get that reinvestment rate risk on a T-bill, and watch that 5% go down to a 3% handle in short order. You want to move out in that 5-7 year part of the curve. That's the best risk reward, I think.
The belly of the curve, the middle of the duration. So let me throw one more question at you, and then we'll get to our favorites. The curveball question is, tell us what Boston Scores is. What do you do working with kids and team environments to help build character?
It's an interesting organization I've been involved in for a while now. And what Boston Scores does, it's the largest K through 12 after-school program for Boston Public Schools. So they partner with Boston Public Schools. They're known for their soccer program, so they provide free soccer programs after school for children to get involved a number of days a week. And they also, in addition to that, provide other enrichment like poetry, and they actually have an entrepreneurial type class, which I find interesting. So this is a terrific way to get these kids together, working as groups. It's about mind, body, and spirit, really. And they learn how they can, solve problems in their community, gets them prepared for potentially going into college, as they come towards their 12th year. So it's terrific. I've seen the outcome for kids, and they have so much confidence. Some of these kids that are coming out, I look at them from where, when I was graduating at that time, it's just amazing what these kids in this program does for the Boston School.
Sounds really interesting. All right, our favorite questions, and we're going to turn this into a speed round. Tell us what's keeping you entertained these days. What are you watching or listening to?
I'm watching The Three Body Problem on.
Loved it.
Yeah. So I read the book a while ago. I was reading the New York Times, like, what is this book?
It's such a slog to get through.
It was. I read all three of them. I actually read. There was a fourth one written by a fan that finished it. Interesting to read if you want to continue that saga. But you know that's on Amazon and Netflix. There's a Chinese version on Amazon.
Oh, really? I had no idea.
You get that one.
Did you see? Did you subtitled? Did you watch?
I started that one and I flipped to the Netflix one because it's faster moving. I think that's a hard book to translate.
I picked it up and tried to read it a few times and just got it's like the first 92 pages of 1984 is a tough slog. But I was down with COVID in March and just binged it, and I thought it was fabulous.
Yeah, typically don't read a lot of sci-fi, but I read that and somebody said, if you like that, read Isaac Asimov, and I was reading Foundation.
Sure.
It's an old, classic.
Once you go down that rabbit hole, there's no coming back. You should be aware. What else? What are the other ones you're watching?
So I have a bigger group of portfolio managers now. We went from 4 to about 8 people, like managing different kinds of portfolios. And what I'm most interested in is behavior biases now, because you get more people in the, in making decisions. It's important for a strategy to have consistency and temperament and all that. The problem is you get 8 people, they don't all have the same temperament. So I want people to really understand what their bias is. So the greatest guy to go to is Kahneman on Thinking Fast and Slow.
Right.
There are all those behavioral biases. I read that again, Thinking Fast and Slow. And the fast part reminds me is that's the intuitive side of investing, right? And we were talking a little bit about that. That's really important. I want to foster that. But that can lead to a lot of behavioral biases. And the slow part, which is more difficult to slow down and really think about, that's sort of the checks. So you have your investment thesis, you're like, go, we're ready to go. You want to keep checking it on those.
Any other books you want to mention, as long as we're...
I think going into the elections, I've been reading a lot. I've done a lot of reading on China over the years. Cultural Revolution, Mao, from Mao to Now is a great one to understand what's going on in China. I think our Eastern civilization history was never that good for a lot of people in the United States. So revisiting that. And one I'm reading now is called Economic Independence and War by Copeland. I think his name is Copeman. Interesting, talking about, even though you have trade that's very interdependent, that doesn't mean there won't be conflict. And it's about trade expectations.
Right.
This is really key. It's key going up to the election because we're talking about big tariffs on both sides of the aisle.
Right. And that's a tax on consumers.
That's a tax on consumers. I think that's inflationary, by the way.
Sure.
And we have to be careful how we, as a nation, respond to these challenges. It's going to be a rivalry, right? But expectations and, if people think one is usurping the other or boxing people out, that's going to lead to possibility of conflict.
You mentioned China. The other book that's next up in my queue is Chip Wars. People keep telling me I have to read that. You read it. You liked it.
I have not, but I want to read it, yeah.
All right. Next question. Who are your mentors who helped shape your career?
Yeah, well, so there's so many. I mean, I remember there was an old banker, Don Lang at Century Bank and Trust. He taught me how commercial lending worked. He's basically, somebody puts a deposit in, we lend them back their money, and we make this amount of money. He went through the math, and I'm like, wow, that's a great return. You lend people their own money. But he also said to me, Matt, because as I was leaving, he said, Matt, whatever you do, stay close to the revenues. That was a good advice.
Career-wise,
yeah. No matter what you do, I think that's something I always tell graduating students. Obviously, Dan Fuss has been an amazing. He's a non-traditional mentor, but he really taught me how to invest. He also taught me this is a people business. Our clients, really understanding your clients. He was very close to his clients, but it's also about people and your work in the organization. There's a lot of stress in investing. We don't try to create that at work, and that was an important lesson I learned from him. And I would say, I don't think he would know he's a mentor on me, but Howard Marks is just a fantastic thinker. I read all of his stuff. He's got the, I would say, tour de force on
the most
he wrote on
important thing.
liquidity, which was amazing. I think people should read that.
What was the name of that?
It's one of the letters he wrote about liquidity.
I'll dig that up and link to it. And the book, The Most Important Thing, was really super seminal. Dan Fuss has all these aphorisms and rules. Did anybody ever put that together? Has there ever been something like that?
We did, essentially.
You
that
did.
was our investment framework.
Right.
I like to think we made it better because Dan was one person, and we've extended that into other markets like securitized bank loans. But it's the same underlying principles.
I would love to see his quotes in like a top 10 or top 20 list. I know in prepping for this, I keep coming across him in various articles and stuff being quoted. I thought it was really some fascinating stuff. Our last two questions. What advice would you give to a recent college grad interested in a career in fixed income or investing?
One thing I'd say, as soon as you can, figure out what type of investor you are, understand what your temperament is. And that sounds easy, but you really got to think about this, and describes where you might fit the best. And I think that's important. You really got to gel with what you're doing. I also think, I wish I knew this, coming into the market, is really don't wait. Even if you don't know what you're doing, just pretend you're in the business and you're trying to invest and make money. Start reading things. And all the jargon and all of the things that go in. Start reading it. If you don't understand something, go figure out what it is. And that will just, keep you going to the next thing and the next. Before you know, you'll get it.
And our final question, what do you know about the world of investing today you wish you knew 35 years or so ago when you were first getting started?
Well, I think I was sort of this view. I was a pure fundamental person. I thought, there was this hard, fast number that you would get, and you could transact on pretty much all the ideas that you would get. And what I realized is that there are a lot of other things that move prices in the market, including technicals, and things can stay cheap for a lot longer. And you really have to understand what the other side of the argument is, and understand what's being priced in. So you might have this great idea, but if it's already priced into the market, it ain't worth anything. So you really have to understand that and see, where your edge is, and understand why that edge is pertinent.
Really fascinating. Yep. Matt, thank you for being so generous with your time. We have been speaking with Matt Eagan, portfolio manager and head of the full discretion team at Loomis Sayles. If you enjoy this conversation, well, be sure and check out any of the previous 500 plus interviews we've done over the past 10 years. You can find those at Bloomberg, iTunes, Spotify, YouTube, wherever you find your favorite podcasts. Be sure and check out my new podcast, At the Money. Short 10-minute conversations with experts about topics related to your money, earning it, spending it, and most importantly, investing it. At the Money in the Masters in Business feed or wherever you find your favorite podcasts. I would be remiss if I did not thank the crack team who helps me put these conversations together each week. My audio engineer is Meredith Frank. My producer is Anna Luke. Atika Valbron is my project manager. Sean Russo is my head of research. Sage Bauman is the head of podcasts at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.